And the final session is really, well, taking what we've learned, but looking at it from the business now, scaling up and potentially positioning for an acquisition or an exit, the sort of things you might do for that. When you reach that scale-up stage, it's all about management and making what you're doing efficient and almost turning the cogs so that it's kind of very systemized. When you're in the startup phase, it's very firefighting, new things, land grabbing, and then scale up is ideally, I think, a bit more methodical.
Processes in place to a degree.
Exactly.
Because scaling up without efficiency costs a fortune.
Yes.
And is extremely wasteful as well.
So that all of that feeds into the scaling as well, making sure that you keep your brand and your ethos as you grow.
Absolutely, yes.
Because that's hard, isn't it?
That's the hardest part, is keeping quality where it needs to be.
Mm. So that boils down a lot to communications within the team and how you do that. And it just gets more complicated when you've got, well, more than one location, but certainly if you start to straddle geography and have different time zones and different languages and different cultures. And again, you were alluding to that as well with your business being in Italy, Australia, France, Paris, wasn't it?
Yes.
Issue, I guess, with scale up is you devolve responsibility to more people below you, and you've got that balance of letting go and letting them do it, but equally being able to sleep at night knowing that they're doing it properly and that you don't have quality issues or legal issues. And if you've got staff in other countries, are they being properly paid? Are you compliant with the local laws? So there's lots to sort of worry about, and having systems at that stage helps, because generally you can apply what you've done in one country or in one market to the next. Mm-hmm. And so I put up there a couple of other things as well. Often as companies grow, because their systems get more complicated, you have software that can help. So even as a small company, you'll have accounting software. But as you become, for example, a multinational manufacturer, you'll have some kind of enterprise resource planning system, maybe. I don't know whether you've invested in this now, but
we have SAP.
Yeah, so SAP's the classic.
We have a nightmare with SAP.
Yeah, most people do. It's interesting. So SAP, Oracle, IBM, a lot of the big companies offer these. They're called enterprise resource planning. So they kind of try and link together accounting, purchases, sales, your supply chain, your manufacturing. And they're good in the sense that they do help you systemize, but you often get a lot of pushback because they're complicated. People don't like entering the data. They're very rigid. And the other thing, just at the bottom there, I mean, what's going to happen in scale up is you're going to be hiring more people, probably, because you're growing to different places. You're almost certainly going to be exporting, because that generally becomes part and parcel of scaling up. You go beyond your home market. All of this will cost money and may require financing, either loans and things through the bank or proper venture capital, depending on how complicated and how extensive you want to grow. And then the last one that's really interesting is blitzscaling, which is an American term, where you kind of turn what you're doing upside down and you just go hell for leather in growth. And you see this with tech companies. So Uber, Airbnb, they're good examples of companies that blitzscale, for good or for bad. And what they do in that situation is they land grab as quickly as possible to stop a competitor getting in. So if you think about it, a business model like Airbnb, to be really successful, you need lots and lots of customers all around the world, because the nature of their business is
basically a monopoly.
Almost a monopoly, yeah. I mean, you certainly want to be the one.
Yeah.
And you can't allow someone to be the Airbnb in Europe at the expense of not getting there first, if you want to be truly global. So what happened with Airbnb and Uber is that they what's called blitzscaled, where they got lots of finance from Silicon Valley, and they really threw money at the problem. And there is a book called Blitzscaling by Reid Hoffman, who's the founder of PayPal and LinkedIn. Yeah, and he talks about this and uses some examples. What you kind of do in this particular situation, and I'm not saying it's a good idea, but is you you almost don't follow the rules. So what we've been kind of talking about is systemising, carefully hiring, carefully doing what, all the things. With blitz scaling, you almost hire everybody you can get hold of. And you literally just accept that there will be mistakes. And you need to have a really well-working business model at that point. You can't blitz scale while you're still experimenting with how to make money. So you've proven you can make money, and all you need to do is amplify that in many places, for example. So again, Airbnb is the classic. You know you can make money by renting off rooms in LA and San Francisco and New York. Now it's a case of just replicating that everywhere. So we've talked about this a little bit before, actually, with the finance. I don't know whether this was one you came to. Yeah, great. So we don't need to go into the detail here. But obviously, that raising finance, where we talked about it before in the early stage and how it works, when you're scaling up, it's continuing. So you're still bringing in venture capital money, if that's the kind of route you've gone down. And we talked about some of the things to watch. The reason these things to watch are more important now is as you're scaling, you're probably wanting more money, which means you're probably going to more sophisticated investors. So by their very nature, they will have been around the block many times. So they'll have lots of quite complicated agreements. They've learned over the years what works for them, which doesn't necessarily work for the founders ultimately. But unless you can play it out as to what's likely to happen, you won't realise until towards the end what these things actually mean. So when you sell your shares, for whatever reason, they may benefit more than you. They usually cause problems when things are going wrong. So in a situation like now, where we've got the coronavirus, money's going to be tight, people are going to have to go back and raise more money, companies are going to have to really watch how they're spending. The people that have taken investment in an earlier round and then need to go back and get more, that's when,
they just trigger
these clauses start to come in to protect the previous investor, usually at the expense of the founders. I mean, there are some there that actually benefit the founder. There are situations where a founder may want to sell, and some of these actually help that process. Because a founder may not want to make as much money as the investor is thinking, for example, or the founder's personal circumstances may have changed and want to get out earlier. What may look like rather tedious document control is really just a way of making sure that you're using, documents that have kind of been signed off by the company. You would be amazed how many people in companies just reinvent their own documents, as in somebody suddenly needs a document and off they go and write one. It could have legal ramifications.
Yeah.
And that becomes more of a problem when you've got overseas subsidiaries. So suddenly they need terms and conditions, in their language or whatever. If you're not careful, then they'll just make that up and it won't reflect what you've carefully considered as your terms and conditions. So without going into the details here, I'm just sort of showing that, first of all, you can have different types of documents and signed agreements that we've talked about previously. And one way of just kind of keeping control of this is using quite a simple system of MICO, which is just a short name for your company. So you make up a short acronym. CC being the country code. So if you've got the UK, you'd have UK. And then if you've got Italy, IT. And then the document number, which then has a version number. So very simplistically, if you have, for example, a non-disclosure agreement in your company, which is a tech startup you would, that might be document number 1.3, because you've iterated a couple of times and you've locked down to 1.3 and everybody should use that. It would be MICO UK, or GB if you want, document number 1.3. And then when the Italians, by example, then want a non-disclosure agreement, they can take that one, translate it, get it through their lawyers, etc., but then give it the thing MICO IT document number, and then so on, and then you can just keep track of it. And the reason this is good in the future is that as your company scales and grows, you'll probably need to start getting certifications like ISO certifications, quality certifications. So there's ISO 9001, which is a quality certifying, and you often need those as a big company to then sell to big companies. And then the other thing a bit related to that is when you're manufacturing. if you're making a product, you want it to be the same each time. You don't want quality control issues.
Yeah.
And so, you will have some kind of process where you're either making to order or you're making to stock, and then you have an assembly process where you build the product. You then store it in the warehouse, maybe for a short or a long period of time, and then you ship. And obviously, a just-in-time manufacturer does that as soon as the order comes in and ships as quickly as possible. Other manufacturers may be doing it in order to meet demand, like a Christmas demand, for example. Or it's just a continuous process whereby you're shipping on a regular basis to shops and other warehouses. Now, again, what you need to do is systemize. And by that, what we mean is obviously make the same thing every time as closely as possible so that you don't have quality control issues. So one way of doing that is to have a system, it's called the traveller system. And basically what that is a traveller is a document, or it's probably online now, as in it's a computer-based system, but it specifies how to make the product at each point. And that traveller is called a traveller because it goes along, it travels with the product along the production line as things are done. So let's, for example, say it was a computer production line, making computers. The traveller would explain, you need these components and you assemble them to make this circuit board at this point, and then you move to the next part of the line and you put that circuit board into the chassis. And then the next line says, and now you put in the power supply and the graphics card, and then you put it in the box and so on. And the traveller specifies exactly what happens. But also, the traveller can be a test document. So what it is it's for each particular batch that you're making. If the traveller says, now put in the circuit board and test that it's connected and running, and here's the test, you then, in effect, mark on the traveller that you did the test. And then at the end of it all, you have a record of that batch production. And if that computer comes back in the future because it broke from a warranty return, you go to the travellers that were used to make it and see if there were any problems in the manufacturing process. As you're scaling up, you have so much stuff going on and more services that the company is using. So I've done a simple one here, but all this is just an online, it's like a web page.
A directory or something.
With with links to what you're using.
Yeah.
So you can set this up as an internal intranet, and you can do this. You can do this on Google sites. You can do this for free and just have it not public, have it private.
Yeah.
But what you do is you can split this up into the sort of different areas and the different departments within your company, and these are just links to the various services. So, for example, social networks. This would be your marketing department, and they might have Twitter and LinkedIn and Facebook as in the corporate versions.
Yeah.
And the reason this is helpful is that you can quickly get to them when you need them, and you know which ones you've got. So even if you don't know the password, you know that the marketing department is looking after your Twitter. And if for some reason people in the marketing department leave or whatever, you as a company still know that you've got that. So the dashboard is really a way of just collating it all together. And what you would do is you could make something like this maybe a bit more attractive as your home page internally, your intranet page.
Yeah.
And people would go to that to access the various services that they control. And everybody knows what's in place. And some of that, is managing the business premises. Some of it is managing the business services, the bank, and so forth. At some point, as you scale up, you may get to the point where an acquisition is talked about. And this is what we talk about being an exit from a business. So an acquisition is where it is bought as a going concern by another company. So, sometimes there are big high-profile examples. So Facebook bought Instagram, for example. But it equally applies to much smaller companies being bought out. And usually the companies that buy a smaller company want the business opportunity that it brings, or it means they don't have to do a lot of new work themselves. So they might buy in the technology, or they might be buying in the customers, or they might be buying in, like we talked about before, the sort of geography that they're working in.
Oh, okay.
So there's lots of reasons for why you might buy a company, and therefore why you may be selling yours. But in terms of how it works, it's very similar to raising finance. So in that sense, there's due diligence done. In other words, the people that are buying the company want to know that the company that they're buying doesn't have any major problems. You know, that it's being run properly, that the money, that it's, you know, the business model is, as you've said, sales are as stated, the accounts are correct. So they do this thing called due diligence, which is where they check that the facts are correct. And then usually what happens is they'll agree a price and then buy the company. And what they're doing when they buy the company is they're buying the shares. Whereas when you're raising finance, you're issuing new shares.
Oh,
so that's the difference. You're not issuing new shares, you're actually selling the ones that you've got. And of course, those shares are owned by the shareholders. So it's the shareholders of the business that are selling their shares to a new owner, and that new owner will then own the business. And the reason it's good often is it's a way for those people that own those original shares to make some money. That's our whole aim. So the investors will be looking to sell at a profit, and the founders will obviously be looking to sell because that's their way of having their windfall. So they may have been paid a salary, they may not have, you know, but they'll have invested a lot of time and energy, and this is the kind of payback time.
Yeah.
But as you can imagine, it's usually a bit more complicated in that there are agreements. So before somebody buys a company, there's usually a set of agreements about not just the price, but what happens if we find out that there isn't what you've said in the company. So what if there are, you know, lies? It could be actual fraud, but also just things that you haven't represented properly.
Yeah.
So there'll be that in the agreements. And then often, before the founders particularly and the employees can change, they've usually got what's called a lock-in or a workout. So often with founders of a business, they're expected to carry on working in the business with the new owners to help smooth the way, explain how things work. And that can be a transition period, yeah. So it'll be 1, 2, maybe 3 years, depending on the business. As a founder selling your business, you want to obviously negotiate a good deal. You need to be aware of this lock-in period and negotiate how short you want it to be. Because often when you're working for someone else, I put their psychological implications. What I mean there is it's really hard for an entrepreneur who's grown their business to suddenly have to work for a new owner. And although you can do it for a short period of time, you know, eventually it probably won't work. You know, their mindset is wrong. So as a founder, you want to be aware that you'll probably find it difficult to work for your new owners for a long period of time. Yeah. So you want to negotiate a shorter period and be prepared for what it will be like, and make sure that you are being paid during that as well. So selling your business is one thing, but to be carrying on working, you should still be paid as well. Yeah, and you negotiate that. And then the other thing that's important, which you should get advice on from an accountant, is the financial and tax implications of selling the business. Because clearly what happens, depending how the transaction is done, you will hopefully get some money, and that's taxable depending on how much it is and how it's come about. So beware that when you get some money, some of it will have to go to the tax authority. Yeah. And that's important as well, because depending on the agreement, there may be some agreement where it's only sold to you on paper, but your money is held until a certain milestone to keep you working and make sure the transition period is good. But what you've got to be really careful of is you may still have to pay tax even though you haven't received the money. One of the key things is try and make the transaction a cash transaction where you can get the cash and pay the tax.
Yeah.
Yeah, and it's all done. So some transactions are share-based, which means they buy your company and they issue you shares in their company as a result. And that
So
might
they absorb yours, but then they
and then that's right. You become part of theirs, and those shares may be on the stock market because they may be a big company that's listed, and then you could sell them and make cash. But you may be restricted. You may not be able to sell them for a year, or you may never be able to sell them because they're actually just a bigger version of your own shares. In other words, they're privately held. They're subject to lots of agreements separately. And that's important because if you receive shares worth more because you've sold the company, even though you can't sell the shares, you've made that gain and you'll need to pay tax. And you may not have the cash to pay the tax. And then the other exit and another part of scaling up is where you list on a stock market. So you don't have to sell the company. You can do what's called an initial public offering. Yep. So the good thing about that is that the shares now float on the stock market. It means they're much more liquid. They can be bought and sold, and the founders could potentially sell some of their shares and the investors could sell some of their shares. But in this case, you're relying on the market. So you are unlikely to be able to sell everything at once because nobody will want to buy everything. They won't trust you. Certainly, as a founder, you're unlikely to be able to sell for a while because, again, the public market is going to want to see those founders staying with the business and keeping it growing. The other thing about going public is you have to be much more transparent with your business. So you have regular reporting and you've got to publish your accounts, for example, every quarter. You've got to disclose what's happening in your business. Can't have insider trading. So there's all the regular rules that you hear about. And it's hard work. It costs quite a lot of money to list on a stock market because you've got to do what's called a roadshow where you go around encouraging the big investors that are like pension funds and equity market funds to invest in you so that they'll buy the shares that you put onto the market. You usually have what's called a promoter, which is the entity that goes with you that does all this and helps underwrite what you're doing. So they provide some reassurance to the market because they've done it before. They're kind of like an agent that goes around with it. It's called the promoter. But the good thing is, you could raise money because you'd issue more shares. Your shares could be more liquid. Certainly, it would raise the profile of your company. Public listed companies are always seen as more
competent, I would say.
Competent, yeah. It's nice to be a FTSE company. In summary, is really, if you're going to scale, you need to systemize and be organized. It's a balance between devolving responsibility and delegating and keeping control of what you're doing. You can't do everything. So the more you have a strong team around you, the better. And then in terms of that exit at the end, the two main approaches are either the trade sale or the stock market listing. And those are what tend to be classed as exits.